You did everything right. You went to an estate planning attorney, you paid the fees, you signed the documents, you transferred your house, your savings, maybe even your investment accounts, all into a revocable living trust. You told your family, don't worry, when I'm gone, or if something happens to me, this is all protected. And for most scenarios, you were right, for probate, for privacy, for keeping assets out of the courts after death. The revocable living trust works exactly as advertised. But there is one scenario, one specific, increasingly common, financially devastating scenario, where that trust offers you almost zero protection. And it's the scenario that's most likely to actually happen to you or someone you love. Long-term care, a nursing home, memory care, assisted living. The average cost of a nursing home in the United States in 2026 is over $100,000 per year. In some states, it's pushing $150,000 or more. And here's the number that should stop you cold. The average stay is 2.5 years. Do the math. That's $250,000 minimum, out of pocket, gone. Unless Medicaid steps in and pays for it. But to qualify for Medicaid's long-term care coverage, you have to be almost completely broke. You cannot have assets above roughly $2,000 in most states. And here's where your revocable living trust becomes a trap instead of a shield. Everything inside that trust, Medicaid counts it as yours. Every dollar, every piece of real estate, every account. Medicaid looks right through the trust as if it doesn't exist. Because legally, it doesn't protect anything. Not from Medicaid, not from nursing home costs. And if you, or your attorney, or a well-meaning financial advisor didn't tell you this, you may be sitting on a ticking clock right now. So today, we're going to do something most estate planning videos refuse to do. We're going to tell you the uncomfortable truth about one of America's most popular legal documents. Explain why this blind spot exists, walk through how families have lost everything because of it, and show you what actually works. Stay with me. This is going to matter. The document America was sold. To understand why the Revocable Living Trust is misunderstood on such a massive scale, you have to understand where it came from and what problem it was actually designed to solve. The Revocable Living Trust as an estate planning tool became widely popular in the United States starting in the 1960s and exploded through the 1970s and 80s. The central pitch was simple. Avoid probate. Probate is the legal process by which a court validates your will, settles your debts, and distributes your assets after you die. It can take months, sometimes years. It's public record, meaning anyone can look up what you owned and who got it. And it costs money. Attorney fees, court costs, executor fees that eat into what your heirs receive. The Revocable Living Trust was the elegant solution. Transfer your assets into a trust now while you're alive. You remain the trustee. You control everything. You can change it, revoke it, add to it, take things out. And when you die, the assets pass directly to your named beneficiaries. No probate, no court, no public record, no delay. For that specific purpose, it works beautifully. And so estate planning attorneys began recommending it widely. Financial advisors appointed clients toward it. Books were written about it. Seminars were held in hotel ballrooms across the country. Millions of Americans, particularly retirees, paid to have these trusts created, then spent years funding them, legally transferring their homes, bank accounts, and investment portfolios inside. By some estimates, today there are tens of millions of funded revocable living trusts in the United States. But here's what didn't get equal billing in those hotel ballrooms. The word revocable is not just a feature, it's a fundamental legal characteristic that has enormous consequences. Because you can revoke the trust at any time, the law treats everything inside it as still being yours. Not yours in a symbolic sense, yours in a deeply practical, legally enforceable sense. Yours for tax purposes, yours for creditor purposes, and, critically, yours for Medicaid eligibility purposes. This isn't a loophole, it isn't a gray area. It's been settled law for decades. Medicaid was created in 1965 as part of Lyndon Johnson's Great Society legislation. From the beginning, it was means-tested, designed for people with limited resources. As long-term care costs rose through the 1980s and 1990s, and as more middle-class Americans began turning to Medicaid to cover nursing home costs, Congress and states began tightening the rules. The Omnibus Budget Reconciliation Act of 1993, known as OBRA 93, was a turning point. It codified aggressive standards for how trusts were treated in Medicaid eligibility. It established the look-back period, initially 3 years, later extended to 5 years, during which any asset transfers are scrutinized. And it made crystal clear, a revocable trust does not shelter assets from Medicaid. But here's the tragedy. The marketing of revocable living trusts never got the memo. The gap. Nobody warned you about. Let me paint you a picture that is played out in hundreds of thousands of American homes. A couple, let's call them Robert and Margaret, retire in their late 60s. They've worked hard. They own their home outright, worth $380,000. They have about $280,000 in retirement savings and a small brokerage account. Together, they have around $700,000 in assets. They go to an estate attorney. The attorney does excellent work. He creates a revocable living trust, helps them retitle the house, the accounts, everything, all transferred into the trust. He explains how their children will avoid probate, how the process will be smooth and private when the time comes. Robert and Margaret leave feeling secure, protected, organized. Fast forward 12 years. Robert is 81. He has a stroke. He recovers partially, but he now needs significant daily assistance. Then, 18 months later, he's diagnosed with early-stage dementia that progresses rapidly. Within a year, he needs full-time memory care. The family calls the memory care facility. The monthly cost, $8,500. They assume Medicare will cover it. It won't, not long-term. Medicare covers short-term skilled nursing care, typically up to 100 days under specific conditions. For long-term custodial care, which is what most people in nursing homes actually need, Medicare pays nothing. So the family turns to the Revocable Living Trust and begins drawing down assets, month by month, the savings drain. After 3 years, $280,000 is almost entirely gone. Now they need to sell the house. Then someone mentions Medicaid. Finally, Robert qualifies. He's nearly broke. Medicaid steps in. But what if the family had known earlier? What if years before the stroke they had understood the vulnerability? What if they had restructured assets into an irrevocable Medicaid asset protection trust, often called a MAPT? More than 5 years before care was needed, they could have potentially protected the house, possibly a significant portion of the savings. They didn't know, and that knowledge gap cost them everything. This is not a rare story. This is happening every single day across America, in every state, to families who did what they thought was the responsible thing, and were never told about the one risk that mattered most. How the misunderstanding spread. So why does this confusion persist? Why are people still being sold or selling themselves on? The idea that a revocable living trust provides comprehensive asset protection? Several forces are at work, and they feed on each other. First, the estate planning industry and the long-term care industry rarely talk to each other. An estate planning attorney is trained in probate, wills, trusts, and estate taxes. Their job is to help you pass assets to heirs efficiently at death. Long-term care planning, Medicaid, nursing home eligibility, spend-down rules. It is a completely different legal specialty called elder law. Many estate planning attorneys have limited expertise in elder law. Many financial advisors have none. So a revocable living trust gets set up. The client's immediate needs are met, and nobody thinks to say, "Oh, by the way, if you ever need a nursing home for more than a few months, this protects nothing." Second, the 5-year look-back period creates a false sense of invincibility for younger retirees. Someone who sets up a revocable living trust at 65 isn't thinking about nursing homes yet. They feel fine. And there's a common, deeply mistaken, belief that they have time to reorganize later if health issues arise. What they don't understand is that the moment health declines and care is needed, the 5-year clock becomes an enemy. If you try to transfer assets after a diagnosis, or even 2 or 3 years before needing care, you may still be inside the look-back window when you apply for Medicaid. Those transfers get penalized. You could be disqualified from Medicaid for months, or even years, with no assets left to pay for care during that penalty period. Third, the internet has amplified the confusion. Search Revocable Living Trust Asset Protection, and you'll find a vast sea of content. Some of it is accurate. Much of it is imprecise, outdated, or written for general audiences without state-specific Medicaid nuance. YouTube videos, blog posts, and financial planning articles often discuss the benefits of living trusts without adequately distinguishing between protection from probate, protection from creditors and death, and protection from Medicaid spend-down during life. Fourth, and perhaps most troubling, some people are sold living trusts at seminars designed not to educate, but to sell. The free dinner estate planning seminar is a real phenomenon. Retirees are invited to a restaurant, given a meal, and treated to a presentation about the dangers of dying without a trust. These seminars aren't always run by elder law experts. They're often run by financial product salespeople who earn commissions. The Revocable Living Trust becomes a gateway product. Once you're a client, they sell you annuities, insurance, or investment services. The living trust itself may be set up properly. But the broader picture, Medicaid, long-term care, the 5-year look-back, often never comes up because it doesn't sell anything. The numbers that should shake you. Let's talk about data because the scale of this problem is genuinely staggering. According to the U.S. Department of Health and Human Services, someone turning 65 today has almost a 70% chance of needing some form of long-term care services in their remaining years. 70%. That's not a fringe risk. That's the majority outcome. Of those who need care, about 20% will need it for more than 5 years. 5 years in a nursing home, at current average costs, can consume over $500,000. Medicaid is the single largest payer for long-term care in the United States, covering roughly 62% of all nursing home residents at any given time. That means a massive portion of Americans who end up in nursing homes ultimately rely on Medicaid, but only after they have largely depleted their assets. Here's the cruelest part of the math. Medicaid rules vary by state, but in most states, a single individual can keep roughly $2,000 in countable assets to qualify. A married couple has slightly more flexibility. The community spouse who remains at home can keep what's called the Community Spouse Resource Allowance, CSRA, which in 2026 ranges from about $30,000 to $154,000, depending on the state. The primary home may be exempt while the community spouse lives there, or if there's a reasonable expectation of returning, but it is typically subject to Medicaid estate recovery after death. That's right, even the house that was exempt while you lived can be claimed by the state after you die to recover what Medicaid spent on your care. And the revocable living trust? In most states, the home held in a revocable trust is still subject to Medicaid estate recovery. Because the trust was revocable, because it was legally yours, the state can reach it. The very document designed to keep your house out of a court process after death can be the mechanism through which the government recovers nursing home costs from your estate. This is the breaking point. This is where I thought I was protected becomes we lost everything, failed fixes, and what actually works. Now, in fairness, the planning world has not been entirely asleep. There have been responses to this problem. Some of them are partial, some of them are genuinely effective, and some of them are traps of a different kind. The most common attempted fix, Irrevocable Medicaid Asset Protection Trust, MAPT. This is a fundamentally different animal from a revocable living trust. When you transfer assets into an irrevocable trust, you genuinely give up control. You cannot take the assets back. You cannot revoke it. And because you've genuinely given up control, Medicaid, after the 5-year look-back period passes, cannot count those assets against you. Done properly, well in advance of needing care, a MAPT can protect your home and other assets from nursing home spend-down and Medicaid estate recovery. Many elder law attorneys consider this the gold standard for middle-class families who want to preserve assets for their children. The catch? You need time. 5 years, minimum. Ideally more. If you wait until health declines, you may not have that window. And if you transfer assets and then need care within 5 years, you face a Medicaid penalty period, a period of ineligibility calculated based on the value of what you transferred. The second tool, long-term care insurance. For those who plan early enough, typically in their 50s or early 60s when they're still healthy enough to qualify and premiums are lower, long-term care insurance can pay for care without requiring asset depletion. It essentially creates a pool of money specifically for nursing home or home care costs. The challenge? Premiums have risen substantially. Insurers underestimated how many people would use these policies and how long care would last. Some carriers have exited the market. The traditional long-term care insurance market has contracted significantly, though hybrid products, combining life insurance with long-term care riders, have emerged as alternatives. The third approach, strategic spousal planning. For married couples, there are legal strategies, allowable under Medicaid rules, to maximize what the community spouse can keep. Spousal annuities, properly structured, can convert countable assets into a Medicaid-exempt income stream for the at-home spouse. This is complex, state-specific, and must be done carefully with an elder law attorney. But it is a legitimate and legal tool. What doesn't work? Last-minute transfers to family members. This is perhaps the most dangerous misconception. Some families, facing a nursing home admission, quickly transfer the house to a son or daughter thinking it will be protected. This is almost always a serious mistake. The 5-year look-back will catch it. Medicaid will assess a penalty. And during that penalty period, no Medicaid funding is available, leaving the family to pay privately when the money is largely gone. The core lesson here is timing. The Medicaid system is designed to catch late-stage planning. The only planning that reliably works is the planning done years, ideally a decade, before it's needed. This is getting worse, not better. Here's the thing about this problem that should genuinely alarm you. The forces making it worse are accelerating. Americans are living longer. The baby boom generation, 73 million people, is now squarely in the age range where long-term care becomes a statistical likelihood. Nursing home capacity is strained. Costs are rising faster than inflation. The Medicaid system is under fiscal pressure in nearly every state. And here's a pattern that elder law attorneys have been watching with particular concern. States are increasingly aggressive about Medicaid estate recovery. When federal law was tightened in 1993, states gained the authority to recover Medicaid expenditures from estates. Many states were slow to implement aggressive recovery programs. That is changing. Some states have expanded recovery beyond probate estates to include assets held in revocable trusts, precisely because those trusts remain legally the decedent's property. Other states have moved toward what are called expanded estate recovery programs. Meanwhile, the gap between what people understand about their estate planning and what is actually true continues to widen. A 2023 survey found that less than 30% of Americans over 50 had discussed long-term care planning with a financial professional. Most of those who had estate plans, including living trusts, believed their assets were protected without understanding that protection from probate is not protection from Medicaid spend-down. The irony is poignant. The revocable living trust was sold as a way to preserve what you've worked for, to make sure it goes to your family instead of getting lost in court costs and delays. And it does that, for one scenario. But the scenario most people face, a prolonged illness, years of care, the slow drain of everything they built, is the one scenario it cannot address. So let's bring this home. 3 things I want you to walk away knowing today. Takeaway 1, irrevocable. Living trust is not an asset protection tool. It is a probate avoidance tool. These are not the same thing. It does one job, getting assets to your heirs without going through court. It does that job well. But it provides zero protection from Medicaid spend-down, and in some states, even your home held in the trust may be subject to estate recovery after death. If you have a revocable living trust and you believe your assets are protected, I want you to call an elder law attorney. Not an estate planning attorney, not a financial advisor, an elder law attorney, and ask specifically, what happens to everything in my trust if I need Medicaid-covered long-term care? Takeaway 2. The 5-year look-back window is ruthless, and it starts now, not when you get sick. If you are 55, 60, 65 today, even if you feel perfectly healthy, the time to plan for long-term care asset protection is right now, not when you get a diagnosis, not when the care is needed. The Irrevocable Medicaid Asset Protection Trust and other legitimate planning tools require time to work. Every year you wait is a year you don't have. Takeaway 3. Most people don't know what they don't know, and the financial and legal industry isn't always incentivized to tell them. The person who sold you a revocable living trust may have done so entirely in good faith and given you exactly what you asked for. But comprehensive elder law planning is a specialty. If your estate planning was done without a specific, detailed conversation about long-term care, Medicaid eligibility, and the 5-year look-back, that conversation still needs to happen. Here's the thought I want to leave you with. The American long-term care system was built on a set of assumptions that no longer hold. It was assumed that families would provide most elder care at home. It was assumed that people wouldn't live long enough for nursing home costs to devastate their savings. It was assumed that Medicare would cover more than it does. Every one of those assumptions has been eroded by demographics, medicine, and economics. And sitting at the center of this mismatch is a legal document created with genuine good intentions, used by millions of people, that was designed for one world and is now being used as a shield in a very different one. The Revocable Living Trust isn't a bad document. It's a misunderstood document. And in matters of money, health, and family, misunderstanding can be the most expensive thing in the world. Talk to an elder law attorney. Have the conversation nobody wants to have. Do it while you still have the luxury of time, because the families who get this right didn't get lucky. They got informed early enough to actually do something about it. If this video gave you something to think about, please share it with someone who has a living trust and hasn't heard this side of the story. It could be the most valuable thing they see this year. Drop your questions in the comments. I read them, and I'll address the most common ones in a follow-up video. If you want to go deeper, subscribe. We cover the financial systems, legal structures, and policy decisions that affect your money, your family, and your future. Not to sell you anything, just to make sure you actually know what's going on. See you in the next one.